Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're talking about my approach to risk management. This is something I haven't really put a lot of material up on, and unfortunately, I think this is probably the most important component that traders can focus on. Regardless of any time frame, any strategy, your risk management is what will ultimately ensure not only your longevity, but hopefully ensure your ability to scale and grow your trading business, but also understanding that this is the critical factor in protecting you. And this is what keeps your psychological capital intact, because when you have a very sound risk management model, everything else falls into place. The number one thing that I think is critical before we progress further is that you must have an edge. If you do not have an edge, skip this entire video and just go generically to risking 1% on every single trade, and that's it, or even less. You must have an edge, and I talk about this and I emphasize this over and over again. It's so critical that you must have best trading setups. And that is filtering out all the garbage down to the highest probability trading setups, and then from there quantifying them and grading them into their setups in terms of the highest to lowest in terms of their probabilities. This is what will allow you to determine your maximum risk per trade setup, your best trade setups. So again, if you there'll be people out there who disagree with this approach, but stay with me and follow this through the fruition. You'll understand the rationale. You want to get rid of all the piker 50-50 types of trades and then be able to quantify your best trade setups in terms of your highest probability, best risk reward setups to your middle range, highest probability, best trade setups, and then to your lowest ones, which would be scalps, smaller movements for risk reward, high probability but lower risk reward opportunities. This will help you determine your probability versus return in terms of what you want to risk on the trade. Position sizing therefore can be calculated along with your method of trade management, which we'll get to in a second. So obviously risking a certain amount of capital and position sizing per trade setup, but then having as part of your trade management plan methods for scaling in and out of the trade, locking in profits, and also the possibility of recycling back into your strongest, best trade setups, which means that you can be extracting profits and re-entering these trades and extracting more profits in the right trade setups, while at the same time, or scaling back into these trades, having locked in profits and also adjusted existing positions in the market to break even, so there's no existing risk in the market, allowing you to re-enter in with a controlled amount of risk as a move continues to go in that direction of the trade. Then also determining your risk capital, which is a personal amount an individual chooses to allocate to trading, knowing that they potentially can lose all of that capital and that it will not impact them on a day-to-day basis in terms of their lifestyle or responsibilities, etc., which basically comes back to just a very simple concept: don't risk money that you can't afford to lose. If that amount is too large, it will impact your ability to execute your strategy effectively, because you will have an attachment, an emotional, financial attachment to the outcome of each individual trade, which will then be impaired by your fear of getting stopped out, fear of leaving profits in the market. So you'll get out of large winning trades too soon. You'll take a small profit. All the things that can affect the trader's bottom line in terms of the overall positive return of the system. Again, we talk about this in other videos. So risking capital per trade, a fixed amount of capital per trade, is all determinant even on that aspect of a trader being consistent, a discretionary trader being consistent on every single trade exactly the same, which is why people who backtest their systems when they do it in the quiet and peacefulness of a dead chart on the weekends then they go into live trading and they don't execute the same as they do in their back testing because of the emotions that kick into live time, which again we've talked about in other videos. Live screen performance is totally determinant on the trader themselves. For myself, I'm typically only in usually one trade at a time. I possibly may have two on occasion, or may take a trade and get into a second trade, but usually I'm only focused on one trade at a time. I am fully out of the market at the end of the day 99.9% of the time. Occasionally I may leave a trailer in, and that comes back to when the monthly cycles are reversing or continuing, I may have a trailer in the market. So therefore, usually when I'm done, I have no risk existing in the market. So quantifying best trade setups allows you then to determine not only are you filtering out garbage. So I'm really big on trading setups themselves because I have a very specific criteria of what it is that I'm looking for. And again, if you want to skip that, if you don't have any best trade setups and you're just looking for a really basic model, risk-reward model, then again, I would just go back to risking half or 1% per every trade and skip the rest of the video. But for me, I have quantified very specific setups and then rank them. And then obviously there are going to be some setups that are in the gray area in between. And I usually dial that down to the next lower level in terms of the risk. So for example, if I have a 5-star setup where I would be quite convicted to scale into that with size, if I'm a little 50-50, then I would adjust that back to the 3-star range and keep that controlled to around 2% max risk. So I talk about maximum risk on certain setups. Now these are my highest conviction, highest probability opportunities with the largest risk reward. Typically my maximum stop on any one of these particular trades would be 25 pips at a maximum. Regardless of candle size or anything else, I will usually be basing this on 15-minute charts. My thesis for entering in the trade will be on a 15-minute chart, but I'm entering in these trades on a 1-minute chart, which allows me to place my maximum stop and control my risk tighter, but also get a better fill. And if I'm scaling in, which I will do on all of my level 3 5-star trades, I will be scaling into these trades. So what that means is that I will be entering into the market, taking a position, and then scaling my size up to a maximum risk of up to 5%, which I know certain traders will not like, but my conviction again on my 5-star setups is that these have the potential not only of high probability of hitting their target, but they also have a high probability in terms of risk reward of exceeding 100 to 200 plus pips on certain instruments. So again, maximum stop loss can vary depending on the instrument itself. So the instrument will be again, oil, gold, NASDAQ, certain indexes, maybe depending on what the traders are trading, the volatility of that particular instrument may be greater than a major currency pair, pound, euro, etc. Where my maximum risk on a major pair typically will not exceed 15 to 20 pips, and that in most cases those can be controlled around 15 pips. So it's really critical to be able to build your playbook, and again, the playbook can constantly be evolving and getting fine-tuned even more. For me, it's my model is very straightforward and simple, and we'll look at some examples of some level 3 trade opportunities. So part of the trade management plan is not only how I will scale in. So typically on my 5-star setups, they're markets that will go high a week, high a month, high of day, but they are potentially a 3-day setup, maybe a 3-week setup, a monthly rollover, again, peak formations, 3 levels. They can be trend trades, or they could be a high of day, low of day trade opportunity, and vice versa. Again, 3 sessions in that risk reward from high to low may exceed 100 pips. So the trade part of the trade management plan within that risk management model is how I will scale in or scale out to ensure that not only am I locking in profit as the trade progresses, but my risk is virtually, if the trade has moved into profit, that I'm also adjusting that there is very little to no risk. And if I have a large range movement, I may have a re-entry into that trade after locking in profit. So, for example, we may have a high of day trade setup that may move 50 to 75 pips before the New York market opens. So we may have a U.S. 12 candle window entry, high of day, it may move 50 to 75 pips. I may lock that in, keep an existing position in at the high. The market could pull back and open at the New York Open to continue that move down for a measured move of 100 pips or more, where I could scale back in and have no existing risk in that first trade and scale back in potentially maybe on that second move up to 2% again. So this is all part of what you need to have within your trade management as part of your risk management model. So typically, with some of the positions, I will have a fixed exit and then scaling out as well as the market is moving in my direction to make sure that I am taking money off the table. The 3-star trade setups are ones that I will dial my risk down to a maximum amount of risk of up to 2%. And again, I will usually scale in. So my first entry will be a 1% risk. And as the trade is moving or accelerating, again, I'm basing my thesis off the 15-minute charts, but I will be entering in on the 1-minute chart. So the 15-minute is what gives me my trade setup. And then the timing window, again, we've talked about this in other videos. You can go and look at the other videos for the timing windows, etc. But I'll be entering in on the 1 minute. So again, I can control my entry faster and keep my risk management tight. So for example, the 15-minute stop may exceed 15 to 20 pips max stop depending on the instrument. But the 1 minute allows me to control that risk, where the 1 minute entry confirming my trade and adding into that up to 2% allows me to control my risk tightly on the 1 minute chart, again to a maximum of 20 pips. Most instruments, regardless if the trade is accelerating in my favor, 20 pips should be fully enough to protect my downside. And again, I may have a session re-entry in that trade. So I could have a trade in London. There may be a gap time re-entry. We could have taken profit on that trade, 25 to 50 pips. So again, coming back to our risk reward on our 5-star, we're typically looking at greater than 100 pips of profit target. Occasionally, some of those trades are going to be 50, but they are very, very, very high probability setups. And then the second model, the 3-star, looking at a minimum of 25, and those will usually continue somewhere between 25 and 50 pips, meaning it could be 40. It may move past 50, but we will lock in the 50. I typically will have a fixed profit target preset to lock in. If it doesn't hit the 50, for example, I could exit on 40 pips if the market was to consolidate or not quite get to my target and the time window for me has elapsed, which again comes back to your trade management plan. I have a time expiry on trade setups, which allows me to not only go to break even, but to be either fully out of the market or closing it out with profit in my pocket. Then there's scalps, which I refer to as session scalps. So they could be high a day, low a day, or a continuation move that's going to be a stop hunt or a trend trade. And I will typically only risk the 1% on that trade, fully in and fully out. Typically they'll be 25 pips, and the maximum risk on those will usually be 15. Occasionally on a higher volatility pair, again, if this trade is accelerating into the move, 15 pips should be enough, because these trades in these setups should not be coming back whatsoever. So the confirmation of the trade, again, so the setup is on the 15-minute, the confirmation is on the 15-minute, and the entry can be on the 15-minute. But if it's a large candle, meaning that first candle confirming the trade may have a pullback, 5, 6, 8, 10 pips into that larger candle, which I will enter in on the 1 minute to get a better fill and also to protect my downside tighter on that confirming 1 minute trade. I'll try to keep the maximum stop and gain controlled to around 15 pips, fully in, fully out with a fixed profit target. So coming back to not being able to, if you don't have best trade setups and you're just trading a certain model, I consider that to be 50-50, which means that I would risk no more than 1% maximum on any one given trade. And this is something, again, I've had to learn in the hard way over time. But this model for me, not only filtering out, there's no 50-50 trades. I have very specific setups that I'm looking for. I know what my upside usually is going to be in terms of, on a 1-star. Usually I'm quite happy to take the 25 and walk away. The 3-star, 50 pips is usually an expectation that I think will be met in the majority of those trades. And the 5-star, again, they can range as much as 300 pips, and in some rare instances, maybe 500 pips. But the minimum I'd be targeting is usually 100. And again, a time expiry or price behavior, the session timing, etc., we want to definitely lock in a minimum of 50, even though it is still a very high probability trade setup. So this is an example of what I would consider a session scalp, an Asian trade. Again, this market moved 50 pips, but we're at the low, beginning of the week, the low of the overall move. The market actually went further than this, but I'd be happy just to take this as a 1% risk trade opportunity. This is a 1 minute chart. This is a 3-star setup for me, high of the day. Even though this is a high of the week, it's a high probability opportunity. I'd still be willing to position up to 2%. So again, entering in on the first confirmation on the 15-minute, but I'd be adding to this trade as it confirmed and accelerated, and extracting profits with a fixed profit target, usually at the low of the day. I would not be holding this overnight. Again, another example of a 3-star opportunity. High of the week, Monday, beginning of the session, high of the previous week. They've gone vertical into the gap time US session. We have a high probability opportunity, part of my best trade setups, but I would take this as a maximum 2% trade opportunity. I would consider this a 5-star setup, and I would be scaling into this trade. The market has gone up high of the week, triple top, high of the month in this particular case. 3 pushes, and again rolling over into the US session, adding into this trade as it accelerated. We have a large range of over 400 pips to come back to the anchor point of where this overall move started. Again, a larger version of a pump and dump, but this is definitely a 5-star opportunity. But you can tell, again, as I accelerate into this move, I'd also be taking profits off and an re-entry into an existing high probability opportunity. But on the second leg of these trades, I would be adjusting my max risk. I've already taken a large portion of this position off with trailers in the market, but adjusted to break even. I'd be happy to add positions into a maximum of 2% on this final move down. Another example of a 5-star opportunity pump and dump setup, high of the week Monday, US session, a move. Again, in a market that's potentially going into a vertical explosion is where I want to be adding into my max size for the explosive move. And again, I'd have fixed targets, taking positions out to ensure that I'm locking in profit, and then the maximum fixed target for the overall complete exit of the market. A high of the day, beginning of the week, continuation of a market that's broken down. I consider this to be a 3-star opportunity, high probability. I would take a maximum position of 2%, first position fully in on the close of the candle, and as the trade confirmed and it was accelerating again, I'm on the 1 minute chart, I would be adding another 1% into the market prior to it taking out this swing low, and then extracting profits on the first bounce down at the previous day's low, holding on to the second position and allowing that to continue to move. There's a high probability for a measured move, but any, again, timing window, etc., These are all part of the trade management plan, but in a market that's broken down and potentially now going on a measured move, I'd be patient to hold on to this, but I'd be adjusting my take profit order on the way down. Again, an example, a reversal low of the day New York market trade and a reversal high of the day gap time into the U.S. Open reversal consolidation for level 3 out of both trades. I would take these as 3-star opportunities and be prepared to scale up to 2% on these trades. And again, probably take fixed profit targets on both of these, the nature of how they're set up, and just walk away extracting that and not worried about holding onto a trailer. I would consider this a 1-star, even though it's a strong trending market. Again, the lower I get in any move or the higher I get in any move, even though it's potentially a larger trend trade, I'd be taking a maximum position of this on 1% as the market could reverse. Even though we're heading into the session timings, I'd be willing to hold on to this market though, because again, this is a trending market. So some setups are going to be arbitrary in terms of me saying it's 5-star, 3-star, 1-star, but I'm always willing to adjust down to the lower level and hold on for a larger move rather than adjust up in hopes of getting more and the market not moving into fruition and having exposed myself to more risk in the market. Again, the lesson I've learned the hard way, there are plenty of great trades. I'm always willing to dial my risk down and hold on for the larger move. So on a scalp, typically I'll be going for 25. In this particular case, we have a broken down market that could potentially continue to fall. I would hold on to that and probably actually trail this, lock in 25, continue to 50. If I felt that was moving strongly, I'd adjust it to 50 and then even hold that market overnight and leave it with a take profit at 50 pips. Again, we're not heading into the weekend, so that's an opportunity that, whereas if the market did close at the low, we could lock in more than 50 pips. If it comes back, I'm stopped out with a 50 pip take profit target. Again, another example of a session scalp, I would take a maximum risk on this trade of 1%. Again, we're already in an existing downward move, high probability of follow through, but I would not be willing to obviously scale the maximum size up on this. I'd take a maximum position of 1% on this trade setup. Counter trend on a very strongly bullish trending market that's reversed high of the week, high of the day, and we have a session trade. Again, I would take this as a maximum of a 1% trade risk. Even though it was a high probability opportunity, we're scalping up towards the 50 pip area. Rather than increase my risk, I would rather dial the risk down and hold on for the larger move. Trade setup that I would take a 3-star setup on this as a maximum of 2% risk. So again, entering in, and as the trade accelerated on the 1 minute or starts to move, progressing in the direction I would add into my second position or my second 1%. And again, breaking any structural low in an accelerating market, I would be going to break even quickly, extracting profits out on one half of my exposure, holding on to the second until the full, unless we're accelerating, holding on for the full amount to the previous low of where that pump and dump pattern began. Example of session scalps, we have a market that's come out of level 3, and again, high probability opportunity on the second day trade setup. I would take a maximum of 2% on a second day trade setup, even though this was a high probability situation. An example of where I would be prepared to hold on for larger than 50 pip move, possibly scaling one position out, holding on to the second one, and locking that in as it moved further beyond the 50 pip area. The other ones were session scalps. Again, a maximum of 1%. We're inside a previous day's high and low, but a high probability trade setup. And again, same situation, high of the day opportunity, but we're down lower. We're in a consolidated trading range. I would risk a maximum of 1% on a high probability opportunity and hold on for the larger move. 5-star opportunity, level 3, 3 pushes, double top, market broken down and rolling over. I would be prepared to scale up to the maximum of 5% on this trade setup. Again, adding positions as the market's price action confirmed. You can see we've broken the swing low accelerating into that move, all positions adjusted to break even, taking profits out, and then potentially scaling back in on the re-entry with a maximum on the second re-entry of up to 2%. All other positions are locked in with profit, but again, an existing strong downward move. Question from traders often is why wouldn't you leave everything in? Well, I am effectively, and I'm adding more size into that trade, but I've extracted the profit out and I'm recycling it back into that move to not only lock in profits, but re-enter that market with more positions to potentially lock in more profits than I would originally just by holding on to that first position that's in the market. Another example of a 5-star fully loaded trade setup, 3 weeks of rise, high of the month, high of the week, high of the day, 750 pip vertical move into a peak formation, our double top M into the US session open. I would be fully committed on a trade setup like this, and I would be holding on for the maximum amount of movement, not only through the low of the day, but potentially for a measured move all the way back down. Scaling and taking profits out along the way, but holding on to some trailers to see, as long as price is behaving and confirming, again, holding on for the maximum amount out of that trade. Certain trades I will be fully in and fully out. An example of this type of market, high of the month, high of the week, high of the day, 3 sessions of rise, and a complete reversal. I'd be willing to potentially leave that last trailer in and or putting in a profit target, a fixed profit target with a trailer to follow that last position in the market. Again, an example of some session scalps where we get a trade in London, we get a trade in the US. Again, I'd be fully in with 1% of risk, taking that profit out. We had a strongly moving market like this. I'd wait for the market to give some evidence of a bottom being in place if it's exceeded the 50 pips, or have a fixed 50 pip profit target in place. If it didn't hit that and we had the pin, I'd be fully out, but a re-entry into the US session, same trade scenario, 1-star setup. High probability, high conviction on the trade itself, but the nature of where we're at in the high and low of the day and the week, I'd be locking in a maximum of 1% risk. And again, a strongly moving market, I would hold on for more than 25 pips as opposed to just a general scalp for 25. High of the day, high of the week. On both days, strong conviction, high probability. I would consider these to be 3-star, maximum of 2% risk on these trades. Again, entering in on the 1-minute time frame, confirmation of the setup itself is on the 15-minute. I would be in the market and adding to that position as the trade confirmed and moved in my direction on the 1-minute chart on both setups. First day, again, we have a middle structure. We're in the first day of breaking the high of the week. I would have a fixed profit target somewhere in the nature potentially of the breakout from the high of the day earlier. But on the third day, day 1, day 2, day 3, this market now has a potential not only to go to the low of the week, low of the day, low of the week, but potentially a second day follow through. So I would be fully out on this day. Again, I'd be maxed out, up to 2% on this trade, taking a first entry out and holding a trailer, and either be out at the end of the day or in the morning. For me, time frame wise, being in Perth. But again, you can see a second re-entry in the New York session the following day in the same trade setup for a second day trade opportunity. In this particular case, again, I would only take a 1% risk based on the high and low of the day setup. Even though it's a second day entry, I would be content to take a 1% risk, but holding on to that or setting a fixed profit target on this market. It has the potential easily in the New York session to move well beyond 50 to 100 pips, but I would set a fixed profit target and probably be out anywhere between 50 and 100 based on the time it took for that market to move. Another opportunity, again, I would consider this to be in the gray area between a 5-star and 3-star. So again, dialing that down to the 2% max risk, but high probability for a larger than 50 pip move. As we see at the pump and dump setup, I expect a minimum return to the neckline. It is Friday, so again, conscientious of making sure that I'm out on the day, not leaving anything in overnight or into the weekend. So again, timing-wise for me, this trade, if it's moving and accelerating, I would have a fixed profit target after it's moved beyond 50 or 75 pips of 100 or the previous day's low. I do not want to be exposed into the weekend. So for me, depending on how fast that market accelerated on the day, I would either be fully out at a fixed amount, 100 pips, whatever that may be. If I felt strong conviction leaving a trailer, very, very unlikely I would be out before the weekend. Low of the month, low of the week, low of the day. This is a 5-star opportunity. They drag traders down early in the day, second day trade, bringing traders down low. A high conviction, high probability, explosive move. This market actually exceeded beyond what I had anticipated. I thought a move to the high of the day was definitely in the books. This trade went, I believe, 1,000 pips almost from top to bottom. But again, entering in on the 1 minute and on the New York session, sometimes the NASDAQ volatile, but this market set up over the 3 sessions for the reversal. We had the W pattern. I would be fully committed on a market up to 5% on this trade setup as long as my fills were not accelerating away too quickly. So meaning I would be happy to scale into this aggressively, but if the market was accelerating too fast, again, I'd be just trying to control that at a 2% risk or even 3%, but taking money off at the first break of the high, leaving the second ones in to continue, the second lots of those positions to continue, and in some cases being the low of the month, etc., leaving a trailer in to the next day's session. Regardless, these are sometimes part of the trade management decisions that have to be part of your risk management model, not only gauging the trade setup, but gauging how you'll extract and manage profits, because understanding what Mark Douglas talks about, anything is possible. Some of these trade setups may behave differently than you expect, and so there needs to be a malleable model either for completely being fully out or being willing to adjust and let a trailer hold on to a market that is potentially now really on a run. So hopefully you got value from today's video, traders. Again, it's imperative that you have best trade setups. Get rid of the garbage. Get rid of the stuff that's completely innocuous and irrelevant to you growing your business. 50-50 is a very, very frustrating, disempowering way to trade. Develop high probability setups that you trade your best, and then be able to scale those or rate them in terms of their not only their probability, their risk reward, how they behave when they set up and they're about to move, and then therefore adjust your risk parameters around those setups and behaviors. And that allows you to then also fine-tune your trade management plan, how you will not only potentially scale into the market, but then scale out, lock in profits, fully exit the market, potentially adjust your stop loss, trailing stop, whatever that may be, a time expiry, whatever those things are that's necessary for you to not only, number one, make sure that you lose the minimum amount on a losing trade and extrapolate or extract the maximum amount out of a winning trade. And again, sometimes it's just fully in, fully out. High probability but low risk reward in terms of maybe 25 to 50. High probability, risk reward can be greater than 25 to 50. So again, 25 to 50 minimum, but the market may move 75 to 100. You may be willing, based on how price behaves, to leave a trailer in the market. All these little things that are all part of the risk management model. Hopefully that helps. Build your best trade playbook setups. Understand how you can manage your risk. This is the one thing that is critical to not only ensure your longevity, but your profitability on your big winning trades. Again, maxing out your winners. Max out your winners, and then the other bread and butter trades, just making sure you hit them. Not a lot of stress. Still extracting profits. You want to squeeze as much out of the winners and then at the same time always protecting your downside and your overall capital management. Have a great trading session. Again, make this your best trading week ever, and may the markets go with you.